Imagine stumbling upon a secret blueprint for the next wave of stock market giants, one that could turn a modest $1,000 investment into $1 million fortune in just 6 years. Alexander Green claims he has pinpointed the next Magnificent Seven, the stocks set to dominate the market. But there's a catch: he won't reveal them unless you subscribe to his exclusive newsletter. In this video, I'll expose the stocks Green is teasing for free based on the clues in his presentation, so you don't have to spend a dime on his service. Remember, no paid or proprietary information is being given away. This is all educated guesswork based on publicly available details. If you appreciate me saving you hundreds of dollars on stock research, make sure to subscribe and watch until the end so you don't miss a single pick. Now let's get into it. Alexander Green is an investment analyst and former portfolio manager now known for his work with the Oxford Club. He's built a reputation for bold predictions and aggressive stock recommendations. He has made some good calls in the past. Furthermore, he was early on Tesla, which turned into one of the biggest winners of the last decade. But at the same time, he's also recommended stocks that tanked, like his overly optimistic bets on small-cap biotech firms that never took off. The first stock Green is teasing is described as one of the most important AI innovators today, designing and licensing high-performance CPUs, the central processing units that power computing devices. He points out that over 280 billion of its chips are already in use, running everything from smartphones to supercomputers. He also notes that NVIDIA's Grace Hopper superchip runs on this company's technology, and Apple has locked in a long-term deal to use its chips in iPhones and MacBooks until 2040. The company being teased here is ARM Holdings, and the ticker is ARM. ARM Holdings is a British semiconductor and software design firm. Instead of manufacturing chips, they license their designs to companies like Apple, Qualcomm, and NVIDIA, which integrate them into their hardware. ARM's power-efficient architecture dominates the smartphone industry and is becoming increasingly relevant in AI and cloud computing. The valuation is sky-high, with ARM trading at 71 times forward earnings and a price-to-sales ratio of 47, way above industry norms. Investors are paying a massive premium for potential growth that's not guaranteed. The AI hype is also misleading. Many investors are lumping ARM in with AI stocks, but most of its business revolves around CPUs, not GPUs, which are the real moneymakers in AI computing. While ARM plays a role in AI, it's nowhere near the level of NVIDIA or AMD in this space. There is also the issue of SoftBank's cash out. SoftBank owns 90% of ARM and has been aggressively selling shares. If ARM is truly destined for trillion-dollar status, why is its biggest shareholder reducing its stake? Another major risk is its exposure to China, which accounts for 25% of ARM's revenue. With rising tensions between the US and China over semiconductor technology, this dependency could become a significant issue. Lastly, the company's growth is not guaranteed. While ARM's licensing model is profitable, its revenue growth has been sluggish, hovering in the low single digits. ARM would need to rapidly gain market share from Intel and AMD to justify its valuation, which is easier said than done. ARM is a solid company, but its current price is just too expensive. The second stock Green is teasing is a company that he says is building a better internet using AI. He emphasizes that AI will soon consume more power than entire countries, meaning network speed and efficiency will become critical. This company operates over 300 data centers worldwide and has built one of the fastest and safest information networks in existence, outpacing Amazon and Google in speed. The company being teased here is Cloudflare, and the ticker is NET. Cloudflare is a cybersecurity and web performance company that provides content delivery, DDoS protection, and internet security services. It helps websites load faster and protects against cyber threats. Cloudflare may be doing some exciting things in AI-driven networking, but you may need to consider it before buying. Its valuation is through the roof, trading at a price-to-sales ratio that leaves little margin for error if growth slows or earnings disappoint. Despite strong revenue growth, profitability remains a concern. Cloudflare has struggled with negative net margins and cash burn, raising doubts about its ability to generate sustainable profits. There is also intense competition in this space. Cloudflare is up against giants like Amazon Web Services, Google Cloud, and Microsoft Azure, all of whom have deeper pockets and stronger market positions. While ARM and Cloudflare are both strong companies, their current valuations make them risky buys at today's prices. High expectations and AI hype have already been priced in, leaving little room for upside unless they significantly outperform. Green's bold claim that $1,000 could turn into millions relies on perfect execution and market conditions aligning just right, which is never a guarantee in investing. Cloudflare is facing an uphill battle against tech giants like Amazon Web Services, Microsoft, and Google, all of whom dominate the cloud security and networking space. Competing with such massive players means Cloudflare could struggle to maintain its pricing power and market share, which puts pressure on long-term growth. Adding to the uncertainty is the broader economic environment. IT budgets are tightening as companies navigate rising interest rates and recession risks, which could directly impact Cloudflare's growth engine as businesses cut back on cloud spending. Another major concern is Cloudflare's over-reliance on small businesses and startups. Many of its customers are in the SMB sector, which tends to be the first to slash spending during economic downturns. This exposure makes Cloudflare's revenue more volatile compared to competitors with larger enterprise clients. While the company's long-term vision is compelling, these risks make it a questionable buy at today's valuations. Alexander Green's third stock pick is one he calls the most exciting and predictable way to invest in AI. According to Green, this company meets all the criteria of a great AI stock. It makes a product the world can't function without, has a long history of increasing revenue and profits, and has no direct competition. Founded in 1984 and headquartered in the Netherlands, this company might not be a household name like Apple, Microsoft, or Nvidia, but its role in the tech ecosystem is just as crucial. Green describes ASML, the Dutch semiconductor equipment manufacturer, and the ticker ASML. ASML designs and manufactures photolithography machines, highly sophisticated systems used to print intricate circuit patterns on silicon wafers, enabling the production of advanced semiconductors. While ASML is a key player in the semiconductor industry, there are some insights to consider, and here's why. The semiconductor industry is in a cyclical downturn, which is slowing demand for ASML's expensive lithography machines as chip makers delay capital expenditures. Another major issue is geopolitical risk. The U.S. has imposed strict export controls on ASML's most advanced extreme ultraviolet (EUV) machines, preventing sales to China, one of its biggest potential markets. If tensions between the U.S. and China continue to escalate, ASML's revenue could take a serious hit. Valuation is another concern. ASML's stock is priced for perfection, with a price-to-earnings ratio of around 40, meaning even a small earnings miss or a cut in guidance could send shares tumbling. And then there's the issue of supply chain bottlenecks. ASML's machines are some of the most complex in the world, and any disruptions in logistics or production delays from key customers like TSMC, Samsung, and Intel could significantly impact revenue. Now let's talk about Green's fourth stock pick, which he calls the world's most powerful generative AI software company. This company is ranked globally as the #1 AI, data science, and machine learning software vendor. Ferrari has used it to optimize Formula One testing, by the Cleveland Clinic to improve hospital efficiency, and by Airbus to increase aircraft production by 33%. It has also gained traction in the energy sector, with companies like BP, ExxonMobil, and PG&E utilizing its AI-driven analytics. The company being teased here is Palantir, and the ticker is PLTR. Palantir has built a reputation as a leader in AI-driven analytics and big data solutions primarily serving government agencies and large enterprises. But despite its strengths, I see major red flags that make it a risky buy at current levels. First, its valuation is sky-high, trading at 42 times forward sales and over 200 times earnings, far pricier than most software peers. This means investors are paying a hefty premium for future growth that is still speculative. Another concern is its slowing revenue growth. While Palantir posted 30% growth year over year, forecasts for Q4 and 2025 suggest a deceleration to 25 to 27%, signaling that its hypergrowth phase might be fading. Additionally, there has been a wave of insider selling, with CEO Alex Karp and other executives offloading $1.2 billion worth of shares. Insiders selling this aggressively raise questions about whether they believe the stock's best days are behind it. Palantir also faces risks in its core government business. With talks of budget cuts at the Pentagon, lucrative government contracts like the $90 million Project Maven deal could be at risk, which would hurt a key revenue driver. Palantir is riding the AI boom, but the stock might be overinflated with a market cap nearing $250 billion and competition heating up from tech giants like Microsoft. If AI enthusiasm cools, Palantir's lofty valuation could face a harsh reality check. Alexander Green's fifth stock pick focuses on AI-powered robotics transforming supply chains. When people question whether AI is just hype, this company is a prime example of real-world applications increasing efficiency and driving billions in economic activity. This next Magnificent Seven contender develops AI software and robotics specifically designed for U.S. supply chains. Its autonomous robots operate inside massive distribution centers, reaching speeds of up to 20 miles per hour to stock and retrieve goods with unmatched precision. The result? Faster, more efficient order fulfillment compared to traditional warehouse technology. This AI-driven logistics company has major partnerships with some of the biggest retailers in the country. It works with Albertsons, the second-largest grocery chain in North America, and has a long-standing deal with Target, the seventh-largest retailer in the U.S. But is it the biggest win yet? A game-changing partnership with Walmart, the country's largest retailer. Walmart plans to install this company's AI systems in every single one of its regional distribution centers nationwide, solidifying its role as a leader in warehouse automation. The company Green is referring to is Symbotic, and the ticker is SYM. Symbotic is an American robotics and automation company specializing in AI-powered warehouse solutions that streamline supply chains for major retailers. While Symbotic has an exciting future, we need to look for more details before considering. And here's why. Symbotic's reliance on Walmart is a glaring red flag. In fiscal 2024, nearly 87% of its revenue came from Walmart alone. If Walmart ever scales back its investment, changes suppliers, or shifts priorities, Symbotic's entire business model could take a major hit. This kind of customer concentration risk makes the stock vulnerable to sudden disruptions. Another issue is profitability, or rather the lack of it. While Symbotic managed to post one profitable quarter in Q4 2024 with $16 million in net income, it still reported a full-year net loss of $84.7 million. A single positive quarter doesn't erase the broader concerns about whether the company can achieve sustained profitability. Green's sixth stock pick shifts gears into cybersecurity, specifically identity management. He highlights a company that recently acquired Palantir, a leader in machine identity management, which significantly expands its reach in the fast-growing cybersecurity sector. Analysts are bullish on this stock, with a strong buy consensus and an average price target of $455, indicating a potential 18% upside from current levels. Wall Street is betting big on this cybersecurity firm's continued success. Finally, let's talk about Green's seventh and final pick, which he believes is the best of them all. This company operates in biotechnology, an industry he sees as the most promising investment sector today. In fact, Green ranked this stock as his #1 pick for 2024. The company specializes in a groundbreaking technology invented just over a decade ago, gene editing. This technology won the Nobel Prize for Chemistry in 2011, and has now entered a period of rapid advancement thanks to AI-driven research. Gene editing allows scientists to make precise modifications to DNA, opening the door to revolutionary treatments for genetic disorders such as Huntington's disease, hemophilia, cancer, and other serious conditions. Green is talking about CRISPR Therapeutics, and the ticker is CRSP. Despite its scientific breakthroughs, it's risky to invest in it, and here's why. First, its revenue has been on a roller coaster ride. In 2024, CRISPR's revenue plummeted nearly 90%, dropping from $371 million to just $37 million. That kind of volatility makes it difficult to count on steady cash flow. Second, profitability remains elusive. CRISPR's net loss ballooned to $366 million in 2024, a 138% increase from the previous year. The company continues to burn through cash at an alarming rate, with no clear path to turning a profit anytime soon. Third, its highly anticipated gene editing therapy, Casgevy, has yet to deliver actual revenue. While the FDA-approved treatment was a major milestone, CRISPR reported zero revenue from Casgevy in Q2 2024, meaning the rollout has been disappointingly slow. Fourth, its pipeline is still in its early stages. Many of CRISPR's next-gen therapies, including its oncology and diabetes treatments, are still in development, meaning investors may have to wait years before seeing meaningful results. Lastly, its valuation is sky-high. With limited revenue and mounting losses, CRISPR is priced for perfection, making it an extremely risky bet. While Green is betting big on these companies, the reality is that all of them come with serious risks. Whether it's overvaluation, reliance on a single customer, slowing revenue growth, or unproven profitability, These stocks carry significant uncertainty. Now, if you found this video valuable and you want to diversify your investments beyond traditional stocks and bonds, I have just the thing for you. Even though I believe that investing in a low-cost index fund is the best long-term investment for the average Joe, the benefits of solid physical gold are hard to deny. I think of physical gold as insurance against unpredictable times, and I'm not the only one. In 2023, central banks added over 1,000 tons of gold to their reserves, the second highest annual purchase in American history. And in 2024, central bank got another 290 tons of gold in just the first 3 months of the year. If the biggest banks in the world are buying tons of gold, I'm sure there's a good reason for it. I found a company that allows ordinary Americans to own and securely store physical bars of gold as part of their IRA account. The best part is that they're giving away a free guide to teach you all about investing in solid physical gold. If you want to learn more about how gold can protect your retirement savings, just click the link in the description to receive a completely free gold IRA guide.